Pushing a complex machine to its absolute limit looks incredibly impressive right up until it explodes. The same principle applies to corporate finance. For decades, investors have treated return on equity, or ROE, as the ultimate measure of capital efficiency. It is the bottom line percentage that tells you how much profit a company generates for every dollar its shareholders put in. Consider two identical competitors. We'll call them High Lev Co. and Low Lev Co. On paper, High Lev Co. generates a massive 92.3% return on equity, while Low Lev Co. sits far behind at 52.4%. If you have to allocate capital today based strictly on this top-line metric, the choice seems obvious. You back the 92. We need to systematically dismantle return on equity to expose the operational realities and the systemic risks hiding inside these companies. Financial analysts do this using the DuPont analysis framework. It's a diagnostic engine designed to rip the ROE equation into its component parts. Because the highest percentage return on a spreadsheet means nothing if it is driven by accounting tricks and lethal financial engineering. The first analytical pillar of the DuPont framework is the profitability margin, which we pulled directly from the profit and loss statement. This chart shows the P&L flow. Starting from top-line revenue, we subtract direct costs, operating expenses, depreciation, interest, and taxes, reaching net profit. But comparing net profit is misleading. These bottom blocks, interest and taxes, vary wildly based on capital structure, not business performance. To isolate pure operational profitability, we look higher up the waterfall to EBITDA, earnings before interest, taxes, depreciation, and amortization. Removing depreciation and amortization clears away discrepancies. One company might aggressively write down its assets, while another stretches them out. By dividing that EBITDA figure by net sales, we get the EBITDA margin. This metric allows us to compare the raw manufacturing or surface efficiency of two competitors. A high operational margin is a strong start, but it leaves out a critical piece of the puzzle. Exactly how much capital did it take to build the infrastructure that generated those margins? Stripping away the noise of tax codes and debt schedules reveals the unvarnished truth of a company's day-to-day business viability. That brings us from the P&L to the balance sheet, the ledger recording exactly what a company owns and owes at a specific point in time. This real-world consolidated balance sheet reveals the scale of non-current and current assets. Every piece of property, equipment, and inventory rolling up into this massive 2.7 million figure represents invested capital, and every dollar must pull its weight. This introduces the second pillar of the DuPont framework, asset turnover. You calculate it by dividing total sales by total assets. This ratio measures how many times the assets of the business are churned or put to use to generate revenue over the year. A low asset turnover ratio is a severe warning sign, often pointing to poor production planning, obsolete inventory piling up, or bloated, non-producing infrastructure. Context matters here. A supermarket requires high turnover to survive its razor-thin margins. A luxury goods brand, meanwhile, survives on very low turnover paired with massive margins. Capital efficiency is the ultimate equalizer. Idle assets silently destroy shareholder value, regardless of how profitable the individual sales might be. The final and most dangerous pillar of the DuPont framework is the leverage multiplier. Remember the denominator in the return on equity equation, equity. Mathematically, equity is just total assets minus total liabilities. This creates the paradox of leverage. As a company takes on more debt to fund its assets, its liabilities grow. That shrinks the equity base. Because the denominator is now smaller, the final ROE percentage artificially spins higher. We can see this debt load directly. This breakdown of corporate borrowings shows a massive volume of unsecured loans. While a shrinking equity base makes ROE look spectacular, it introduces existential risk. These current maturities represent immediate cash obligations that must be paid. To see if the company can survive this debt, we use the interest coverage ratio, dividing operating profit by interest expense. It acts as a vital heartbeat check to ensure the company generates enough earnings to service its loans. And if you want the ultimate lie detector for accrual-based metrics, you look at the cash flow statement. The golden rule, a high ROE paired with negative operating cash flow means the company is booking paper profits but slowly suffocating in reality. Financial leverage acts as an accelerant. It magnifies returns during boom times, but guarantees total collapse when credit dries up. The DuPont framework synthesizes these three pillars into a single equation: ROE equals profit margin multiplied by asset turnover multiplied by the equity multiplier. Now, let's run the data for high LevCo and low LevCo through our diagnostic engine. Here is the first reveal. Low LevCo actually possesses superior operational margins, 22% compared to 20% for high LevCo. Second, low LevCo operates with greater capital efficiency. They generate a higher asset turnover ratio, turning their assets 2.4 times a year compared to high LevCo's 2.3. High LevCo's massive 92%